Today's video, we will be discussing how to understand a set of company's accounts, what the balance sheet is, what the profit and loss is, what the cash flow is, and how you can use those for your competitive advantage. Today I'm joined by Tej Gill of Niger Accountants. Who better as an expert to share this topic with us than Tej, as he's actually shared it with Google on a Google campus to their new entrepreneurs. So welcome, Tej.
Hello, Andrew. Thank you for having me again.
Yeah, well, it's great to have you back. We always get a lot of engagement in the topics that we've covered, from CIS and VAT and other stuff that people need to know if they're in business or property. But today, one of the things that we keep getting asked is, I don't really understand my set of accounts. So we're going back one sort of step from technical detail to the basics, and we want to sort of explain what the different documents are that you can expect to see, why they're relevant, and how you can use them to your competitive advantage. So Tej, if we kick this off from a balance sheet perspective, what is a balance sheet?
Good question. So a balance sheet. So when you get your accounts from your own accountant, there'll be a fully detailed set with a balance sheet, P&L. There should be cash flow in there, and then notes to support them. The balance sheet is all you get, though. If you go to company's house and pull off a set of accounts of somebody else's company, the balance sheet generally is all you get, unless the company's of a certain size and they have to file full accounts. So actually, the balance sheet is probably a good starting point to go through, because it's what people will see when you go to look at a potential small tenant or something like that. Obviously, the larger blue chips will have a full set of accounts there. So the balance sheet it's a statement that shows the assets and the liabilities that the company has at a point in time. So balance sheet is always on a particular date, the company's year end. So it might be 31st of January, 31st of March, whatever the company's year end is. And what it shows at that point on that date, that it shows what the company owned and what the company owed. So, you'll have it is generally, they can be laid out in different ways, but generally at the top, you'll have all the fixed assets, the long-term assets. So for a property business, that's where you will have the land and buildings, the depreciation on there, and, any additions that you've made, that will all be sitting up there at the top. Then you'll have other fixed assets in there as well, maybe investments in a subsidiary, if you've got a group structure, and other longer term investments as well. Then you'll have the current assets. Current assets are basically things that can be turned into cash within 12 months, let's say. So it will have cash, but it will also have things like your debtors, people that owe you money. In a property perspective, that would be people, any rent that's due for the next month, maybe. If somebody's made a prepayment or somebody hasn't paid yet, that will be on there. If you've made a prepayment, that might be on there. And then that gives you your total assets. Then off there, you have the liabilities, which again, you have current liabilities, so things that are due to be paid within 12 months. And then long-term liabilities, which will generally be any HP agreements, if you've got any longer-term assets that you've bought on finance. And there'll be your loans to the bank that are due to be paid as well. So then that gets you to your net asset position. And then offset with that, you have the share capital and any reserve profits that you've made over the years, which will balance off with the net assets, and that will show the statement of the company. Now, in loose terms, the balance sheet could be looked at as the liquidation value of the business. So if you just down tools one day and said, I'm giving up, then the balance sheet on that date, you down tools, could be loosely translated to be what you might expect if you went and said, right, let's sell all the assets, let's cash in all the money that's owed to us, go pay off the people that we need to pay. That net asset figure is roughly what you should be left with. Obviously, selling in a fire sale situation, you'll probably get less than that anyway. But let's assume that that's what it is. So that's kind of where the balance sheet sits. It gives you the financial health of the company on a particular date. A lot of people think that it's a year long thing, like a P&L is, but it's not. It's just on that one day, and broadly what you should expect to get in your pocket if you liquidate everything on that day.
What we're saying is the balance sheet is like a photograph of the company at a point in time. So that is a helpful way of looking at it. Now, do they do the balance sheet every single week, month, or is this just up-to-date information or out-of-date information?
So this depends on how you want your numbers done with your accountant. So the one that you see in your accounts is obviously that's a one-time snapshot on that date. When you see it, when you pull somebody else's accounts off at company's house, there will be the one-time snapshot at that date. Generally, you have 9 months to submit your accounts, so it's going to be pretty out of date. Now, if you, for yourself, if you wanted it done more regularly, you could take a view of your balance sheet every day. You just need to have your bookkeeping done every day, which a lot of people don't do, understandably. So, a daily balance sheet is not really practical. A lot of people do see it monthly. If you're getting monthly bookkeeping and reconciliations done by your accountant, then you can have a look on QuickBooks, Xero, whatever it is. Use the app, log in, and as long as everything's brought up to date, then you can see your balance sheet on a monthly basis. I'm not sure that there's many reasons why you would want to look at it on a monthly basis. I think there's probably more value in looking at the other financial statements on a monthly basis as opposed to your balance sheet, but it's certainly possible to do that.
I'm familiar with organisations that do look at it on a regular basis, and they're organisations who specialise. I worked in banking, for example, and they have to manage their balance sheet closely and elements of it to stay within ratios. But to stick to the topic, you said there's other things that you could look at more regularly. Now, might that be the profit and loss account, for example?
Yeah, exactly, and that's the one that everyone is generally concerned with. And from a property perspective, you can understand why, because if you're going to go to if you've got a buy-to-let portfolio in a limited company, and you go to a mortgage lender, they're going to want to see the accounts. The main thing they're going to be looking at is what are the sort of the reserves in this company to be able to service any debt. So the P&L is a very important document for that. So I guess a little bit on the structure and the background of the P&L. So a P&L will cover a period of time. Generally, for an annual set of accounts, that will be 12 months. If you've got a longer period, it would be however long the period is. If you've extended your accounts up to 18 months, it'd be an 18-month period. If you get quarterly management accounts, it'd be a 3-month period. But it is covering a period of time. And generally, if you look right at the top, there will be a set of dates from and to, so you know exactly what period you're looking at. And you bring in all the stuff that everybody knows and loves: your turnover, your cost of sales, to give you your gross profit, and then all your overheads related to that. Now, those numbers can look different depending on what type of property business you're running. A rent-to-rent business will have a lot more stuff in its gross, in its cost of sales to take out if we get to gross profit. You'll have the rent paid directly to the landlord. You have sources fees and all that sort of stuff up there. Whereas for a regular buy-to-let business, if you have an agent's fees that you pay, for example, that won't even appear on the balance sheet. It will go to on the P&L. It will go to the balance sheet. So once you take off the overheads, you get down to a net profit line, or EBITDAR, which is a measure that's generally used for valuing businesses.
So if we stop there 1 second for our audience, EBITDAR. I mean, I know what that means, but could you just explain for the audience what EBITDAR is?
Sure. Yeah, a bit of jargon busting. So EBITDAR stands for earnings before interest, tax, depreciation, and amortization. So what it essentially does is it says, right, what's the money that this company's made based on it being just a business, right? So almost like looking at it as an enterprise. What does this business make? Because if you think about what depreciation and interest are, it's how you've decided to fund the business, right? So somebody might have gotten a load of debt to fund the business, and therefore the interest charge will be quite high. Now, Andrew, you got deep pockets. You might come along and buy it outright and not need that debt. In which case, if we took interest off first, then your EBITDAR would look a lot better than somebody that's funded it with debt. So by looking at EBITDAR, you look at the business as a business without concerning yourself with how it's been financed and funded by the owner of the business, because that can be done in lots of different ways: own cash, other people's cash, grants, loans, whatever you want want to use to do it. So that's what EBITDAR is, kind of levels out the playing field for different businesses to look at their profitability.
So it's effectively a benchmarking, a leveling off, so that everybody's compared on the same basis. We will be going into policies in a future video, accounting policies, depreciation. You can choose a policy that fits your business, which might be different to a different business. So it allows you to compare an apple to an apple rather than an apple and a giraffe.
Exactly.
So
Giraffes are better.
yeah, absolutely. We all love a giraffe. So in terms of the profit and loss account, sorry, I stopped you there when you mentioned EBITDAR.
Yeah, no, that's fine. So then after that, yes, you deduct off the costs around how the business has been financed. So that'll be your interest, and then you depreciate your assets and everything to get to your PBT. So that's everything that's in a P&L. It shows you the overall profitability of the business, and then that flows back into the balance sheet to the reserves and shows you the performance over a year. So if you're looking at Company's House, for example, and all you can see is someone's balance sheet, one way of being able to look at whether they made a profit between 2 years is to go to the bottom of the balance sheet and look at the reserves and see whether it moved, right? Because if someone's reserves was £10,000 last year and this year it's £100,000, that indicates that they made £90,000 of profit in that year. But it could be that they made £100,000 of profit and took out £10,000 of dividend, which is why it's only 90,000 increase. So it gives you an indication, but if a number doesn't move between 2 years, it doesn't mean they didn't make a profit, because they could have just taken a dividend for the whole amount. So it's an indicator, not an exact number, not an exact kind of figure that's exactly what's happened.
Absolutely. And that's one of the things that I always look at in a company's accounts. The very first line I zoom into on the balance sheet is what is happening down on the reserves line. Yeah. Are they taking out all of the money? Are they growing the company's reserves, therefore growing the company's value? Once I've looked at that, I will then start to scan up and look at the current liabilities and current assets to see whether there is a risk factor there. Now, when we're looking at current assets and current liabilities, that's sort of bringing us into a cash flow statement where I'm going with that particular one. So this is another document that we have as company owners and directors. What's the purpose of the cash flow statement, Tej?
So the cash flow statement is to, well, literally what it says. It's to show you the cash flow of the business during the course of the year. So it will give you the cash generated, the cash that's been spent, that's been invested, that's been used for running the business, and then it will give you a net cash increase or decrease figure. And the importance of that is that, as you rightly said, Andrew, if you look on the balance sheet of the current liabilities and the current assets, which cover a 12-month period, so the current liabilities are your liabilities due in the next 12 months. Your assets are current assets of the assets that should be liquidated in the next 12 months. If the liabilities are higher than the assets, that implies the company is not going to be able to meet its next 12 months worth of obligations, payments. And in that case, you start worrying about the health of the company. And the cash flow statement supports that kind of analysis to be able to say, well, okay, what is the cash flow generation in the business? Because, if a company's made a heck of a lot of sales, this may not apply so much to a property business, but if you've got a trading business, they made a lot of sales, but those sales, the customers haven't paid, that is troublesome, because the creditor figure is going to go up, the amount owed to the company is going to go up. They might not be paid for a while, and so the cash flow position of the company is going to be impacted. And as long as a company is generating cash, it can actually be loss making and still survive, right? So and that's why when people say cash flow is king, they're correct, because as long as you've got money cycling through the business, you can be making a loss and it doesn't matter. You can be massively in debt and it doesn't matter, as long as you're servicing the debt. And if you think about it on a personal level, anybody with a mortgage, is massively laden with debt. Your income, from your job, maybe 50 grand, 100 grand, and you might have a £500,000 mortgage. Looking at that, you immediately think, my God, this person's going to be ruined. But actually, they might have £500,000 of debt, but they may only have to pay 15 grand a year in capital and interest. So their salary should be able to cover that, so they can carry on paying that 15 grand a year, meet their obligations, and eventually they pay off the debt. And it's the same concept if it's a company that's borrowed a lot of money to fund its property portfolio. It's the same thing if it's a country that's printed a lot of money to get you out of the COVID hole. As long as they can carry on paying it. People say a few years ago, people saying, "Oh, well, we've only just paid off the World War II debt." And that's exactly the point. You can have a debt sat on you for a long time, as long as you keep paying the capital and interest back that you need to, that you're obligated to, then nobody's going to come and close down. As soon as you stop meeting that, then you're in trouble. And that's where looking at the cash flow statement, looking at the current assets and current liabilities, is an important part of analysing a company's financial statements.
I do agree with you, and I have a couple of things to chip in at this point, which you mentioned. If a company's growing its sales and the debtors balance is growing because they're giving credit to their customers, just remember, you're being a charity and you are having to fund that out of your business, be it an overdraft, business loan, director's loans, to provide that free credit to the debtors. And that therefore makes you running your business as a charity. The other big point at this precise moment in our economic cycle is, if that debtor level is growing, how capable are all of your debtors of paying back the money for the sales that you have made? The sale is only a sale when the cash hits the till. Remember that. And going into a recession, if their business falls over, that sale, you've basically given those goods and services away for free.
That is a great point. The way sort of I explain it to clients sometimes, if you give a customer a lot of credit like that, you've essentially become an investor in their business. You have now taken on risk, and yes, a trade creditor sits higher than a shareholder in terms of order of payment. But if you're not secured, you're still very unlikely to get anything. So, by providing customers with a lot of credit, or being very generous and very understanding in collecting your debts, you essentially become an investor in their business, and that may not be a business that you would otherwise choose to invest in. So you need to be very careful with that. The other point as well on that, Andrew, is that if you're charging VAT, say if you're a business that charges VAT and you're not getting paid, you're essentially paying VAT on money you've not actually received. If you're paying VAT on an accruals basis, which most companies do. So you could be not only funding their business, you could be paying VAT out of your own pocket and waiting to be paid later on. So it's not a great situation to put yourself into, for sure.
I do agree with you. Now, you mentioned a statement, cash flow is king. Yeah. Couldn't agree with you more. I mean, how many businesses do we see, like in the good old days, and I say the good old days, when cable TV companies and cable internet companies were digging up the roads and ploughing millions of pounds worth of cable in, but their business wasn't cash flow generative, and what happened was a series of takeovers. Now, that is something for people to watch out for, and what I use alongside the cash flow is king is, we've talked about a profit and loss statement, and lots of people are like, oh, look at the profits we've made. I counter that with, profit is for your vanity. Cash flow is for your sanity, and your cash flow statement is your most important statement here.
Yeah, absolutely. Yeah, I think the old adage used to be that the turnover is vanity and profit is sanity. But actually, if that profit's not actually translating into cash, then it's pointless. It really is. You might as well not, because you're not only the VAT, you're going to end up paying corporation tax on that, and you might not. It's just, you really need to make sure that you're cashing in your chips every time. And not leaving that out there. And as you rightly said, with the economic environment as it is, that just becomes riskier and riskier. I agree with you fully on that.
It does. So what might we use a set of accounts for then, Tej? I mean, are they useful for anything other than the tax man?
Uh, they are. So obviously that you either get given your accounts by your accountant and you use it to make management decisions. And that, the accounts we've talked through are very much, annual financial accounts that are prepared because you're obliged to. The accounts you can get your accountant to prepare on a quarterly basis, monthly basis, are far more useful for making decisions about your own business and how you might want to proceed. Is there going to be cash generated to be able to make another investment? Are you not going to have enough cash to justify buying another property? So you might go look at alternative investments, gold. Some people love crypto. Whatever it is, it helps you make those decisions. It also allows you to make decisions early in terms of things like paying into your SaaS, paying into or deflecting money to other investments or buying assets that will help reduce your tax bill because you can claim capital allowances on them. Those decisions can be made within the year. Once a year's gone, it's too late. So you can use management accounts to make those kinds of decisions. And when you get to a certain level of sophistication, a certain level of income, you really should be getting those done because the money being left on the table is far too great.
So we're effectively talking about a set of management accounts there, is what you're describing. Now, that is very useful for operationally running the business. I believe in looking at your set of accounts, and the financial accounts I look at as the rear view mirror in the car. You've already driven past the scenery. You can't change it, you can't impact it. The management accounts are a bit like driving the car, looking out the windscreen, deciding where you're going to turn the vehicle and what your direction of travel is.
That's it. The key thing is that the management accounts, we turn them around for clients within sort of 6 to 8 weeks of the end of the quarter, say. So you're still in the year. So they are historic, but they're not as historic as your annual accounts, and they're still within the year. So you're still in that, you're still in the game, if you like, for that year to be able to make decisions and drive the car whatever direction you want to drive it in based on what the information is you're being given there. The other thing that's useful for management accounts is a lot of people don't, they get hit with their accounts at some period of time after the year end, and you get told you've got 20 grand of corporation tax to pay, or your director's loan account is overdrawn by £50,000 and you've got there's a tax to pay on that, and that people might not have that cash sitting around to be able to pay those. So by getting those management accounts during the year, you can prepare for that. You can make decisions to try and mitigate that, and you can actually make sure that you've got the funds there, so you're not ending up paying late payment penalties and fines and interest. So it allows for planning on a lot of different aspects. The other set, obviously, we've talked about having your own accounts for your own business and making decisions based off those. The other, obviously, thing you can get are other people's accounts, like we said, from Company's House, and what's useful for those. Now, what the information that's there at Company's House, as we said, is somewhat limited, but you can use it to start making inferences about other companies and what other company might you want to look at. So if you've got a tenant coming in, I think I've seen you say before as well, you should be looking at their accounts, assessing how they're doing. And on Company's House, you'll only get their balance sheet, but as we said, look at the reserves, look at that trend over a number of years, because you can pull off every set of accounts that's ever been filed. Look at the current assets, look at the current liabilities. How has that trended over the years? It's all about trends. Like a balance sheet, like we said, is one day on a particular date, which in itself doesn't give a lot of information. But over looking at how it's gone over time, then you get a better idea of what it is. If it's a company that's consistently had higher current liabilities than current assets for the last 5 years, and they're still going, then there's probably not too much to be concerned about. But if you are looking at a potential tenant set of accounts, I would say actually you're within your rights to say to the tenant to provide you with a full set of accounts, with a full P&L, with a full cash flow that you can look at, because you by providing them your building to operate out of, you are again investing in their business. You're putting trust in them that they'll pay you what they're saying they're going to pay you. So you're within your rights to say that you want a full set of accounts from them, and then that gives you a lot more information to analyze and make an informed decision.
Absolutely. Well, the other thing that the accounts can be used for, and I've used them for this before, is buying other businesses. And
Yes.
if you understand the set of accounts that you're reading, you'll know exactly what you're buying before you even turn up at the front door. And
Yeah.
where it's useful is looking at what their debt structure is, what mistakes they've made as to why they're selling it. Now, it could be the company's hit the buffers and run out of cash because they've made a bad decision to make a sale to a company. They've given the company credit and that company's not paid them. So that bad debt has gone sour and that has impacted their cash flow.
Yeah.
The underlying business might actually be sound,
Yeah.
but it's understanding the narrative of the accounts, the transactions, and how you go through interpreting them and the questions you need to ask. Now, we'll cover questions you need to ask, what you need to be looking out for in a future video, because these are the next step on when you're starting to become a business owner, be it running your own property business, be it buying businesses, or be it running your own trading business. And we'll look at things like, if a property is for sale, should we be buying that as a property, or should we be buying the company which owns the property? Because there are some interesting points to bring out there, pros and cons from both routes.
Yeah, absolutely. Yeah, we get asked that question quite a lot. Where a vendor's selling property, should we buy the company that it's in, or should we buy the property itself? And as you say, there's pros and cons of both. There's stamp duty implications each way. There's due diligence implications each way. So there's a lot of things to think about in that kind of scenario.
Well, one thing we haven't covered, we've covered the balance sheet, we've covered the profit and loss, and we've covered the cash flow. Often the accounts have a series of notes.
Yeah.
What's the purpose of the notes? I mean, surely it's all about the numbers, isn't it?
Yeah, I think the way to look at it is they're maybe we should add the word explanatory notes alongside them. It gives you more detail, a bit more color behind the numbers, because creditors will be sat on there as creditors. And then, that could be made up of accruals, it could be made up of loans, it could be made up of HP creditors, it could be made up of, various different things, trade creditors, whatever it is. And so the notes are there to provide another level of detail. They won't go into a whole load of detail and tell you every single bank that has lent money to this person or this company, but it will give you an idea of starting to look at, well, what is in there? Because if a company has got massive creditors, but that creditor is a director's loan account and it's the shareholder and the director that put the money in, it's not such a liquidity concern. So it starts giving you a bit more information to be able to play with, and that's really the purpose of the accounts. And the fixed asset note in there tells you what's been bought, what's been sold, and everything. So it's just giving a bit more explanation behind the main numbers that you see, and it's really useful when you start getting into, like you said, buying businesses or looking at potential tenants to see, well, how exactly is this business funded.
I couldn't agree with you more on that point. I mean, I know I look at the funding streams of a business, and it might not just be a director's loan, it might be an intercompany loan.
Yes.
And people will go, oh, it's so highly geared, that's going to be running at a risk. The thing is, if the money's been lent from the left hand to the right hand, the left hand and the right hand are not going to foreclose on each other. So the loan is safer than going to the bank or going to the market and taking a bond loan out. You're going to keep trading.
Exactly. Yeah, it gives the extra detail and gives you more ammunition to go and ask questions. The numbers are indicative, and it should be leading you to further questions. They're not going to give you the answers. It's not going to give you all the answers. It's leading you to the right questions to ask.
Absolutely. Well, if you're enjoying this video, smash that like button, hit the subscribe button, and hit the share to share it with your friends who might also benefit. And if you want to reach out to Tej Gill at Ninja Accountants, his website address is just below, and he would welcome you to fire him some questions, ask what he's looking for. on the comments box below. So please do reach out to Tej, and he's a great accountant. You'll follow him on TikTok. He's got a great little TikTok channel. His audio on the TikTok is quite loud, so don't have your speakers on.
Yeah, don't watch it when you're putting the kids to sleep. Yeah.
But on the other side of it, I'd like to thank you very much today, Tej, for joining us on our Understanding Company Accounts. This is the start of a series, so please smash that subscribe button, and you will be the first to know when we release the updates on each and every element of the company accounts to help progress your knowledge. Tej, thank you very much for joining us today. Any parting words for the audience?
No. I think we've covered everything there. Thank you for having me again, Andrew. And yeah, I think that there'll be other aspects to think about in the future videos as well. So yeah, if there's any questions, I know it's a bit of a technical topic, and some people might have want to get things clarified. Then yeah, drop me an email or put a comment below, and we'll come back to you.
Perfect. Well, thank you very much for joining us once again today, Tej.
Thanks for having me.